I'm Steve Spencer. I'm a partner at SMB Capital, a proprietary trading desk in New York City. Today's video is titled How to Stay Out of Trouble. And what I'm going to do is walk you through a technique that I've used to keep out of trouble in a quick moving market. And generally this will apply right when the market opens and things are moving very quickly, and this can be a difficult time to control your risk. So what we're going to look at is a couple of recent examples from our AM meeting. For those of you who aren't familiar with SMB Capital and how we run our AM meeting, what we do is we identify the most in-play names for the day. We have a proprietary methodology which we use to identify the most in-play names. If you're interested in learning how we do it, how we selected the stocks I'm going to discuss in today's video, we have a 2-hour free workshop where I spend about a half an hour going through this technique. Click on the link above, sign up for that 2 free-hour workshop. And in addition to our stock selection technique, you will learn 3 really good risk-reward setups that we use on our desk here in New York City. What we do in the morning meeting is we actually have written notes, what we call as our written game plan notes. And in those notes, I will put in multiple resistance and multiple support levels, and we label them. Resistance levels R1, R2, sometimes even R3. Support levels S1, S2, S3. And what I'm doing there is I'm identifying prices based on reading of the recent price action as well as the price action following a strong catalyst or event such as earnings or an FDA announcement, where the stock is likely to make a significant move off of those prices. I'm not necessarily making a prediction right off the bat saying it's going to blow through these prices and move a big amount, or it's going to fail at this price and reverse a big amount. What I'm trying to do is identify the stocks that are going to be most in play, and then identify the prices where it's likely to make a large move, and then as I gather information on the open, when a lot of volume comes in, fine-tune my thesis. And so I'm going to look at 2 recent examples for you and remind you what I said at the top of the video. This is a technique that is going to help keep you out of trouble. Now the bonus part of the video is I'll kind of walk you through, after the keeping out of trouble part, we'll walk through kind of some trades that developed potentially where we made some money. But at the beginning, I want you to understand this really is going to help you stay out of trouble and avoid unnecessary losses. And just to hammer home on this point, one of the things I see most common in developing traders is the idea that they just want to do too much. In short-term trading, the market's moving where you're looking at in-play stocks. They're moving up a lot, they're moving down a lot. People, developing traders think, I've got to make a trade, I've got to make a trade, I've got to make a trade. What you do by identifying the key levels is you're going to slow down and wait for things to develop at those levels, and then take good risk-reward trades. And so that's what we're going to look at today. And the other thing, obviously, is the stock selection process itself, which I mentioned at the top, is going to make sure you're in the right stocks, which that in itself is a filter to make sure you're in the best risk-reward trades. So if you're in the right stocks, and then you understand the levels where stocks are going to make significant moves, where you can very limit your risk, you're going to be just more consistently profitable. The first example is TWLO, TWLO. So this was the day following the reporting of their earnings. It had a positive reaction to the earnings. Here are the notes from our morning game plan. What you can see is the ticker, then next to that the support levels we were looking at, 76 and 78. And then resistance, I had 3, 83, 84, 85. Oh, and then sometimes in the notes I'll also put an inflection, which is also an additional kind of heads up to say, if the stock is opening above the inflection, right on the opening it's above the inflection, let's look at a long until we come up into the resistance areas and see how it behaves at the resistance areas. Or if it opens below that inflection or it drops that inflection right on the open, let's look at it as a short down into those support levels and then see how it behaves at those support levels for a bounce. So in this case, it had good earnings. It was gapping higher. And you can see right on the open, it actually opened above the inflection, just a little bit above the inflection. And on that first 2-minute bar, it actually went through R1, R2, and then to R3. So we know it had a lot of momentum. And so the basic rule that will keep you out of trouble is right on that open in the first, let's say 15 minutes when the market opens at 9:30, is if a stock very quickly blows through all of your resistance levels, do not short it. So for example, we have R1 and R2 on the sheet. And let's say right on the open, it went up to R2, which was 84, and very quickly dropped back down below R1, 83. I might be looking for that to trade back down to the inflection and see what it did there at 80 and possibly go down to our support levels. But because it blew through all of those resistance levels, what I'm going to look for is to see if it holds above R3. And over the next 15 or 20 minutes, it held above R3. You can see it came down and tested it. The most common thing we see is when something on the open blows through all of our resistance is look for the retracement back to the top resistance level and see if it holds. And if it holds, we then start to think about a follow-through trade and another leg higher, which it did later in the morning. So that'll keep you out of trouble. Let's give another example. The second example was more recent, and this was GEOS, reported earnings very recently. We had 62 as support. We only had one support level. We had 68 and 70 as R1 and R2, and we had 66 as our inflection. And so in this case, GEOS opened right above our inflection of 66. So initially, we were going to look to see what happened at R1 and R2. And you can see we were looking at a 2-minute chart. And again, in the first 5 minutes, it blew through R1 and R2. What did it do over the next 20 minutes or so? It consolidated above R2, our top resistance. So we watch to see if it holds there. And if it does and starts to move up, we look for a long trade for another leg higher. And in this case, this one actually reversed. So I want to talk to you a little bit about this reversal trade and how I thought about it. And I know people, it actually reversed all the way from R2, from 70, you can see it got below there, and went all the way down to support a little bit later in the day, down to 62. And so when I see that much strength and momentum on the open, and it's consolidating above R2, I'm not thinking short at all. I'm thinking this is a long. If it pulls in a little bit closer to R2, which is 70, close to 70, get long. Small risk to below 70. And then my first sign that it's weak and may reverse is when it comes down and starts to hold below 70. And then you can actually see it starts to consolidate below 70, breaks to the downside. The interesting thing is it erased that entire opening drive. That is when, for myself, I'll start to think about, okay, this stock failed above 70 on the open, had a hard down move to right where it started from. It's consolidating. If it breaks to the downside and takes out, starts to hold below R1, which was 68, it holds below, which it did there on the right side of the chart. It's consolidating below. It breaks to the downside. That to me is a pretty good short. I'll see what happens at 66, and if it holds below 66, we know our support, which is 62, and I think a few hours later, eventually it hit 62 before bouncing at the end of the day. And so this is going to keep you out of trouble. Understanding when we come in, most times we're identifying good support areas, good resistance areas, and quite often most stocks will fail at the resistance areas and they'll come down to the support areas, they'll support the support areas and bounce back up to the resistance areas. That's the most common pattern. And you can fade in those scenarios. But when a stock either breaks through all of your resistance right on the open, or vice versa, I know we only talked about the long setup today, but vice versa, if we have multiple support and right on the open, it blows through all the support, it's the exact opposite of what we talked about here today in terms of if it comes back up to S2, fails at S2, then we look for the short, follow through. Exact opposite. So I hope this keeps you out of trouble, and less can be more in trading, even when you're trading on a lower time frame, and it'll make sure you're only in the best risk reward trades.